Oh, sorry, I think I took your mic.
Oh, thank you.
So a little bit about the panelists. So Sonal is a principal at Tau Ventures, and they invest in early stage AI startups in healthcare, enterprise, and automation. She's had a successful career in M&A, evaluating multi-billion-dollar deals with Fortune 500 companies in India. She was previously chief of staff at Signos and holds an MBA from Wharton. And she's also an avid photographer, going to remote parts of the world and taking really cool pictures. And Raed is a founding partner of Transform. He's a seasoned entrepreneur with 20x outcomes and 3 failures, which turned him into a VC later on, and an institutional LP. Raed played a key role in wireless policy innovation and introduced in-flight internet through Jaguar Wireless and SkySurf. Now he's based in Silicon Valley. He's co-founded Mubadala Ventures and established Transform. He holds an MBA from Cornell, and Transform typically invests in deep tech and impact companies. So I think to start us off, what emerging technologies and applications has you both the most excited in 2024?
Ladies first.
I'm going to go ahead and say AI. Well, in our case, what we're really excited by is, we started as an AI first fund back in 2019. And with our team, we've all been engineers, founders, or builders. And we're really excited that with Gen AI, a little more than a year ago, it's actually brought AI to the mainstream, and it's accelerated adoption, a lot of these technologies out there. So within AI, what we focus on is digital health, enterprise, and automation. On the enterprise side, been seeing a lot of tools like sales enablement tools, things to make sales executives more efficient. I think what's really cool about the field that we're in, and also where we are just geographically, is the pace of innovation. And so there's always scope for just like learning and getting up to speed. And one of the recent areas we've been looking at is voice AI. We've made one investment in a digital health company in that space last year. But of course, everyone's been seeing the news of the latest companies in this space. So that's one that we're tracking. Another that we get excited by is also just in the clinical trial space, because that's a process that has like so many inefficiencies. And so we're excited with AI kind of shortening that whole cycle and also reducing a lot of costs there. And I'm going to pass it over to Raed.
Great. So I'm going to say, is this on? Can you hear me?
Yeah.
All right. So I will say AI with impact. All right. Oftentimes, founders start building things, solving problems, great. And they only start thinking about giving back once they're millionaires or billionaires. Well, at Transform, we say no. As part of our initial investments, we ask our founders, and we put this in our side letter, to pick one impact measure, just one, that a founder could measure from day number one, even if it's 0 for a while or even a long while, it doesn't matter, so long as it's top of mind, so that they're thinking about giving back and being impactful to the world. We measure impact in 3 different ways, 1 or 3 different layers. One, we look at the entrepreneur themselves. Are they underrepresented? Do they come from a disadvantaged group of some sort? Then we look at their hiring practices. Are they hiring people that are disadvantaged or come from a minority or underrepresented group? And third, we look at the business outcome. So whatever that product or solution, does it make the inexpensive cheap? Does it enable a community group or underrepresented group to be more empowered? So those are the areas we think Silicon Valley is going to start turning its attention to, is impact along with tech.
Awesome. So I think 2023 was a cold splash of water in every founder's face when they went to go raise money. I know it was for me when I was trying to raise money last year, where typical meetings and due diligence times seemed what typically would take 3 to 4 meetings to go get a check, we're taking 5, 6, 7, 8 indefinitely. And it was a huge headache for us. And so my question would be, do you expect due diligence times to decrease in 2024 as they were comparatively to 2023 and recently?
Sure, I'll start. I mean, yesterday I was approached by the SaaS startup that has AI that will do my work for me. So If I adopt such a solution, then yes, it will be much quicker. That being said, it's Silicon Valley is going through an interesting times at the moment where it's not as founder friendly as it's been in the past. So what used to be a lot of momentum investing is that lots of things happening, you just want to get into the deal. That happened in 2019 until maybe 21. That's over time has been less the case. Therefore, I guess VCs have been taking their time to really pick the best companies that align with their interests and their criteria and so forth. So a long-winded way to say, I don't think diligence times will be shorter. I think it will be longer, but it might become more efficient with the use of AI.
I would kind of second your thoughts there. Not going to decrease, at least this year, unfortunately. I think there are a couple of factors here at play, right? Like one is supply of capital, which gives VCs more leverage in this case over founders, and them just being really mindful about where we're investing in this year. So. Unfortunately, I guess on average, the due diligence times are going to stay more or less the same as last year. But to the other point also, it's interesting how we as investors are trying to invest in the next wave of innovation, and one of them is going to be AI that replaces VCs. But we do see that happening further down, so in growth or later stage, where there's more data points. At the seed stage, at the pre-seed, it's about the founding team, it's about the technology, it's about having that vision of where the market is going and whether there's a fit for it in the near to medium time frame. So thankfully, I think as early stage investors, some of us are a little more secure, but it's definitely going to help down the line along the growth stage.
Well, there you go. You got to be a little bit more on it.
I would like to add, though, that Silicon Valley, in our opinion, remains to be kind of the best place to build a startup in the world. Silicon Valley happens to be a bit more insular than other places. So we've started an initiative and a movement called impactabillion.com, if you want to check it out. Impactabillion.com, where we take Silicon Valley on a roadshow to the inner cities of America and Canada. I'm Canadian, so we got to always include. Where we identify overlooked, underrepresented founders, bring the Silicon Valley rigor to them, help them crack the valley in weeks instead of years. So we love events like this and Founders Village because it allows us to see entrepreneurs not from Silicon Valley generally who are trying to tap into it. And that's exactly the kind of talent that we think us and Tao and others can, if we can help you crack the valley in weeks instead of years, then we've done our job right.
Yeah, as an LA transplant, about a year and a half ago, this place is eons above any other ecosystem I've ever experienced. So if there's any way you can make your way to the valley if you're out of this ecosystem, I highly recommend it. There's no place in the world like it.
I got to ask you, though, because I know this is a question that's going to come up. Did you make the move to help with fundraising, and has that helped with the fundraise?
Actually, yeah, I did. I made the move from Southern California's ecosystem up here, and it was primarily for fundraising, and it was the best decision I've made. The access to capital, and not to mention the bullishness of the investors up here, it's really different from any other ecosystem. You'd spend what people experience here with those long diligence times was 10x down south, and much less capital, and the mentality of those investors are pretty different than they are in the valley. And not to mention, when you come up here and you're with so many other extremely smart people, you start feeding off of each other, and everybody's energy levels are up here. And like I said, I've never experienced any other place like it. So the next question I have is, how is the looming threat of a potential recession affecting investment activity?
I can take this one. So in our case, we're fortunate in that we closed our fund in April of last year. So we still have a good 2 years of deployment left. So not affecting us as much as a lot of the other firms that have been negatively hit by this. But what we see in the market is that a lot of firms are being more mindful about their capital allocation, about where they're allocating their funds to reserves, so for their follow-on investments versus actually making new investments. We've come across firms kind of modifying their strategy and deciding, okay, we're going to be very bullish on, say, the top like 10%, which is likely going to return our fund, and we'll actually let the other companies die, unfortunately. So we've come across firms that have taken a more, you could say, like militant approach to this. But on the other hand, we have firms also deciding that we're only going to double down. We're going to wait for our next fund to close. And once that next fund is closed, then we're going to deploy more capital into new companies.
So I'll say that the VC asset class in general is really quite interesting. And particularly in the early stage, the stage you guys are playing, you men and ladies are playing in, is quite insulated from the macro happenings. Yes, we have, potentially a depression, all these interest rate issues and so forth. But essentially in the early stage, at the pre-seed, at the seed, whatever you're building is of such high risk, and that it's, most likely than not, it's going to be unsuccessful, of course. But it's going to take very few of you to work really hard, real smart, to take the company where it needs to go. So long as you're solving for something that's truly needs to be solved, and you're doing a great job, you're doing it 10 times better than anyone else, then you're going to find that there is capital for you. I would be less concerned about the macro climate and all that. And of course, as you progress and you're building your product, you get through product market fit, you show traction, you have the data, you'll find that VCs at the Series A and the Series B are going to be very happy to back you. And by the time you get to the Series B or C, the market macro conditions will have bounced back. In which case, you become billionaires and make us, make us millionaires when you become billionaires. That's how VC works.
All right. So with that in mind, do either of you expect any changes to the criteria that investors have for startup funding in 2024? And if so, what would they be?
No.
All right.
Listen, we look for founders that are frugal, that are resourceful, that can get a lot done on very little. So if a founder is wasteful, well, wastefulness scales really well. So if you're wasteful with $100, guess what? If I give you $1 million, you're going to waste it even quicker. Yeah. So we pay attention, and investors like us, we like to invest in lines, not in dots. So when we meet a founder, that's a dot. Have a second meeting, that's a second dot. We can draw a line. Have a third meeting, a longer line. So we look at also, do the founders do the things they say they're going to do? Do they show up on time? Do they over-tip at restaurants? All these little things add up to give us a worldview about that founder and their ability, their willingness, how they work with their co-founders and so forth. So it really comes back to team. So this has always been a criteria for, I think, the best VCs like Tao and us, and this is no different. So I gave you that no, but I think it's helpful to elaborate.
I'd say that with just how things are changing, in our case at least, the criteria doesn't change. Again, because of the seed stage, it's mostly about the team. But what we do see at slightly later stages is just VCs looking for more data points, more proof points on execution. Before the Series A, you could have an ARR of 1 million and raise a pretty good Series A. Now you're expected to have something closer like 3 to 5. I mean, of course, it depends on your particular industry and what you're building for. But more traction is what VCs look for. And that's kind of bled down a little earlier on also. So of course, in our case, in the pre-seed, there really isn't any traction. So that's kind of a moot point. But at the seed also, we're seeing, more firms just looking for those proof points of execution.
All right. So if you ever take a VC to dinner, make sure not to get the filet mignon and tip 20%. All right.
That's right.
Yeah, the true that.
That's what, please apply to our VC.
So what challenges and opportunities do early stage startups face in the current fundraising climate, and how can they position themselves for success?
Well, I think one of the things that I mentioned is this is a bit of a long game. So, you shouldn't go to a VC and expect things to turn around in 1 month. There are very few founders, maybe at the top 10th percentile, who are able to close their rounds like remarkably quickly, especially if they're repeat founders, sometimes even if they're not. But with most people, what we suggest is keep conversations ongoing. If you're looking to raise, of course, you should be having these conversations, but well in advance, try to pick VC's brains on advice. You've probably all heard, if you ask for advice, you get money, and the other way around. There was one investment like that we did last year where we came across them. We don't typically participate too much in pre-seed, but got in touch with the founder, really liked what they're doing, and we're going to keep warm for the future. And then a couple months later, he pinged me. He was going to be in SF, and so we met at TechCrunch Disrupt. And then he kept sending me these investor newsletters. He didn't really ask me to be on it, and of course I didn't mind. But that helped me see how he was so proactive in terms of his outreach with other investors. And it's kind of playing this game, right, where you're not really asking for money, but at the same time you're kind of pitching yourself. So I think it's really critical for founders to kind of learn how to play that long game compared to just raise when you're raising. And in terms of challenge, there's always going to be really great companies around. So you have to figure out how do you develop those relationships, because at the end of the day, it also does boil down to relationships, especially when you're just starting out in the Bay Area, when you don't really have a lot of those relationships to start with.
So I'm going to echo much of what Sonal said. I'll regurgitate in my own way. So for starters, everyone pull out your phone, and there's a book you all have to read. It's called Fundraising by Ryan Breslow.
How original.
So Ryan Breslow is a good friend of ours, an equity partner of ours. He's wrote a book. I would say it's worth its weight in gold, but it's really a very thin book. So it's worth much more than its weight in gold. And it's the audio version is only 50 minutes, so you can cover it very quickly. So encourage everyone here to get that book, listen to it, read it. Ryan Breslow, Fundraising. So the book is orange or red or something. Yeah. So, and what Ryan says, and this is really kind of best practices, the best thing you should do when you're building relationships with VC, the first word that should come out of your mouth is, I'm not fundraising. Okay. The nice thing when you're not fundraising, no one can say no. But someone can say yes if they really like what you're doing. And the idea is to continue building those dots, having those non-fundraising meetings. And then at some point, once you've signed up this big customer account, or you've accomplished something really quite interesting that deserves to have a round, or if someone says yes unexpectedly, that could actually be a trigger as well. Then you talk with everyone else with whom you had just been not fundraising and say, oh, this thing happened. So you create momentum around that round, and then you can create a round. And one of the mistakes founders do is they always try to shoot for a big round. And when you shoot for a big round, that makes you less scarce. But if it's a small round, what happens is that VCs are going to start, if they're like you, of course, and like the company, they're going to say, oh, well, can you let me in? And then you can do them the favor of expanding the round, as opposed to you asking for a big number and not getting there. So if you really want 3 million, raise 1. And if someone says, oh, I really want like this, I want to put more, say, well, okay, fine, I'll do you the favor. Or maybe you'll raise more money at a higher cap or something. So, but you're kind of in control of the process. But read the book, there's so much wisdom in there, and I'll leave it at that.
Yeah, great point, actually. Because I know in our case, we raised a relatively smaller round and then oversubscribed. And that says a lot more than, trying to raise a large round and struggling to fill that up. We raised 500 and went up to 550K oversubscribed. And so it really sends a good message out there that your shares are in demand. So we're kind of running out of time here, and I know you have to get going soon. So what key advice do you have for entrepreneurs seeking funding in 2024?
Everything I just said.
There you go.
I would add to that with what Armand did and what we've seen a couple of our founders do and what we've advised them. It's great to be scrappy. It's great to have teams in remote locations, especially if you don't really need them to be in person. You're cutting down on a lot of burn that way. And it's important to, even today, like raise with, say, 12 to 18 months runway at the very least. But to that point, it really helps when the CEO is in a place such as Silicon Valley or like New York or any other place on the East Coast, because it's one thing after another. Like there's so many events that happen. Get into as many of them as you can, because you never know where a conversation can click. When you're speaking with an investor, if it doesn't work out your way, or even if it does, at the end of the conversation, ask them, is there anyone you suggest that we chat with, or is there any introduction that you can make for us? Introductions are a little bit tricky if a VC hasn't committed yet, but you can always ask for names if you don't, if you're still looking for like more VCs to work with.
Yeah, I'd like to add that, and this is a mistake I made frequently as a founder myself, is I would think the VC is the most important target for me. And the truth is no. The most important human for you is your user or your customer. So be obsessed with them. Don't go in like a dungeon somewhere, build this vision in your mind and you thought, oh, the user is going to love this. No, get out there. It's okay if you're embarrassed with your product. Get out there, get the feedback. If you can get them to part ways with their money, that means you're doing something good. Maybe, and if they're not, then maybe you're not. So you adjust. And just know that VCs follow users. VCs follow customers. That's because oftentimes you would pitch us an idea that we really don't know much. We don't know if it's a good idea or a bad idea. But the best signal we can get is, oh, well, this is what my users are saying. Or better yet, this is what my users are paying. And that's the signal that VCs want to hear, so that they can say, okay, I still don't understand what they do, but someone with money is willing to pay for it. Okay, I'm going to take a bet on this.
Yeah, great advice. And actually, to the point of the customer, being customer centric, during our investor calls, we actually would bring in our customer to come in and talk about why they needed the product and why they're willing to pay for it. And that's really what allowed us to raise this money so quickly, was when the CEO of another company is willing to jump in a call to talk about how much they need the product. That speaks volumes. So yeah, I think Sonal, you might have to get going, but we would like to do a short Q&A if anybody has any questions.
Thanks.
Yeah, thank you for having us.
Yeah, thank you. Thanks.
But if you have any questions for Raed,
What's your name? Want to get the microphone? Yeah.
Yeah. Thank you very much. Well, I'm
Your
Sufyan.
name again, please. For
Yeah,
the
I'm
microphone.
Sufyan. I'm the CEO of a company called Raed A, and we prevent blindness due to an eye disease called AMD.
That's amazing.
I'm sorry, one sec. We can't hear him. Yes. Go ahead. Yeah.
Okay. So I'm Sufyan. I'm the CEO of Raed A. It's a French company that will not be based here in San Francisco to prevent blindness due to a disease called AMD, or macular degeneration. So it's a deep tech / med tech company. And you were talking about don't raise a lot of money, like start by asking like 500K maybe, or like $1 million, even though you are looking for more. I tried that. And what I've been told is that like I'm not credible enough. Like when you ask for little money, especially for that kind of companies, then people say that I don't know what I'm talking about, and then I'm underestimating my needs, and it means that I don't have the right vision. So that's why like I want to agree with you, but
So I'm going to say, first of all, this may or may not be true, that you're credible or not credible. So you got to understand what gives you credibility in your field. Is it having an advisor? Is it having some sort of paper that's published? So I don't know your field very well, but, and by the way, all of you who are interested in fundraising, you're welcome to submit a founder form on our website. Go transform.vc/founders. We want to hear from you. So it's obviously case specific. So you have to understand what gives credibility to your startup. So we can take it offline, but that's essentially what I encourage you to spend time thinking about.
Okay, thank you.
Thank you.
Hi there, my name's Hayley. I'm founding very early stage, a company called Bubble. We're like Airbnb for sharing houses. And
Isn't that what Airbnb is?
no, this is peer-to-peer. So this is someone else rents a house
Swapping
on Airbnb.
homes.
No. Okay, this is someone rents a house on Airbnb and they bring it to my platform, and then they can break up the rooms and rent the rooms. Or they could get the house from anywhere. We don't care where they get the house. Could be a tent. The question is, I'm not a non-technical founder. I'm looking for a technical co-founder. And so I'm at a fork right now where I probably got a little bit of incorrect advice. And there's the question of build a low-code, no-code MVP, or start building product and get, it'll cost 3 times as much. So the quote says, so which way would you go? I'm hoping you're going to say what
I have a question. Is this, so this reminds me of one of my early startups where I used to have a website called saloncanada.com, yellow pages for hair salons. One day, a hairdresser who used to pay me $20 a month calls and says, Raed, this thing isn't working. So just being the stubborn guy that I am, I took out his number, I put my cell phone instead. And my phone started ringing with all these customers calling, hi, I'd like to get a color and a cut. So I'd say, sure, I'll call you back. I would call the salon, find an opening, call her. So I just built a manual solution to prove this out. And then once I delivered, I don't know, tens of calls like these, bringing thousands of dollars, I'm like, okay, how can I automate? So I wonder if this is something you could do, is just do this completely manual, show the traction, and use that traction to induce technical founders to join you, or even better, investors. And then you can hire those technical chops to build the automation. So something to consider.
So you don't recommend, I've already architected a low-code solution, but you say don't go low-code for a split second.
I'm saying try both.
Try both, okay.
The idea is, again, focus on the user and the traction.
Yeah.
Don't just stay still, I'm not going to do anything till I get a CTO.
We have started, I'm fully in it. I'm trying to get out of an agreement and to go low-code. That's what I mean. Like I've gone down a path of not low-code, of real web app.
Low code, no code, doesn't matter.
Okay,
What matters is the customer traction.
Yeah.
If you can get that somehow,
yes,
then you can point to something. Someone's willing to pay for this.
Yeah.
Then a whole bunch of people are going to come to you.
Thank you.
Co-founders, investors, more customers.
Yeah. I've been doing it for 10 years anyway on the side myself. That's why I did it. But
There you go. Yeah.
Thank you. All right. Anyone else?
Good morning. My name is Zia. I am the co-founder of a startup called Revlix. So we're essentially building a Yelp for nonprofit organizations with features of OpenTable and GoFundMe. So we help the nonprofit organizations to match more volunteers and donations on an individual level or corporation level. So we already built our MVP 2 months ago, and right now we built like over 30 partnerships with nonprofit organizations in San Francisco Bay Area. So my question is, what kind of traction are you looking for pre-seed? Because right now we're pre-revenue, because it just felt like hard to tell them like at this level, this stage, we want to charge you already. So we just commit to like we want to grow with you together.
Sure. It's mostly about the vision and the sort of things you've accomplished. So we look at 3 things. We think to build really companies that generate outlier impact and outlier financial returns. We believe there's 3 key ingredients. One is some sort of a deep tech, AI, complex engineering, material sciences, something like that. 2, and really is the most important thing, is the network effect. So a marketplace is a network effect. There's 16 different types of network effects. They're not all created equal. Go to nfx.com and read up on this. Is very, very important. And the last is that 10x advantage. If whatever you're building is not 10 times better than anything else, then customers will not leave what they have to come to you. So at the pre-seed, you want to articulate these things well and show as much evidence of that as much as possible. And just do all these things, build the relationships, do the not fundraising, and then you'll land someone who might align with your narrative. So that's what I would say.
Thank you.
Of course.
Hi. First of all, I want to give a recommendation to every founder. I like the recommendation of fundraising. There's a new book by Jerry Newman and Elizabeth Zauman. Jerry is a founder of New Capital. It's called Founder versus Investor. And it's beautiful because Jerry is the investor of Elizabeth, and they disagree on every page. So it's really, really, really insightful. But I have a question. So the question is, what is the one investment, successful or not as successful as you thought it would have been, that you're still proud of telling the story about today, and why you're still proud of?
Yeah. Well, I'm proud of all my investments. It's like my kids. Talk about them forever. The one that kind of stands out a little bit is a company called Ample, only because it's a Silicon Valley company that we're the only Silicon Valley investor in. It's been really an undarling. Everyone's thought it was a bad idea, and it's proving out to be a great idea. So Ample provides full electric energy to any EV in under 5 minutes. And they have a compelling business model where they charge zero upfront. They only charge a fee per mile. So they make more money per Uber car than Uber. And it's, since we've invested, we've been followed by Shell Energy, Blackstone, other big names all outside of the Valley. So we're pretty excited about that one. But, we're equally excited about all our kids.
So my name is Ahmad. I'm from Germany. So I just moved here recently because I know this is the place to be. So I just built up my startup, but I'm in a transition. So I came to the idea, okay, if I'm in Germany having a transition, why still do it in Germany? Much better to come to SF. So basically my question is, because I'm solopreneur up to now, is about co-founders and equity share. How should it be splitted? From the beginning or in the middle? What is your opinion or your experience?
Yeah, my opinion is if it's not obvious, if the split is not obvious, then go 50-50 or equal. If you're 4-25 each and so forth. If it's obvious, then it's obvious. And that's worked really well because, of course, if someone ends up not pulling their weight or so forth, then you need to have mechanics in place to take the shares back or have it vest over time and so forth. But that's my advice, is just go for equal.
Because there are like many, say, written things about like CEO has to have 1% more, 2% more and stuff. And this is what it makes.
Are you referring to co-founders or you're referring to executives? So co-founders is different, right? If you're starting on day one, some guy is a CEO, the other is a CEO, it doesn't matter. You're all going to do everything anyways.
From the beginning,
yeah,
equally. And if it's
so
one
it has to be commensurate with effort and risk. Okay? Effort and risk.
Exactly.
So think of those two things. Are they taking the same risk as you? Are they putting the same effort as you? If yes, and yes, 50-50.
Yeah, you did exactly what I think.
Yeah.
But
But think of risk. Are they putting more money than you? Then that needs to be compensated. So maybe that portion of the money can be treated as an investment at a lower safe than even us. Okay, so that may end up being 52-48. But really, on the common share will be 50-50. You just have 2 extra as a preferred because you're an investor for that 20K that you put in.
Okay, thank you.